You know the feeling, right? January rolls around and suddenly it's all new year, new me. We all hit the gym, we try a new diet. But what if all those personal resolutions were secretly fueling something way bigger? A massive, predictable reset of the entire economy? Well, that's what we're going to dig into. So let's ask that question head on. Does our collective urge for a new year, new me actually create a new economy every single January? Is there a real, measurable January effect that we can actually point to? And it turns out this is way bigger than just your personal habits. From the gym floor all the way to the stock market, our resolutions send these huge, predictable shockwaves all through the financial world. Okay, let's start with the most obvious impact, the resolution ripple effect. When we decide to change, when millions of us do it all at once, the marketplace really has no choice but to change right along with us. Just think about this number for a second. 53%. That's more than half the population suddenly deciding to get fit. That isn't just some small trend. That is a massive, almost overnight shift in consumer demand that businesses absolutely have to react to. And you can see the consequences immediately. I mean, for some businesses, January is a total gold rush. Gyms get packed, almost 40% busier. And things like Veganuary, sales just explode. Deliveroo sees a 117% jump in plant-based orders. But, for every winner, there's a loser. The alcohol industry sees sales plummet thanks to dry January. Our personal goals directly reshape the bottom line for entire industry. And that ripple effect, it shows up clear as day in the broader economic data. Right after that holiday spending hangover in December, retail sales consistently bounce back in January. And that's not a coincidence. That's millions of us buying new running shoes, new blenders, and tons of health food to kickstart our new lives. So, if our resolutions have such a real impact on Main Street, what about Wall Street? Well, this brings us to one of the market's most famous and maybe most debated calendar quirks. It's called the January effect, and the traditional theory goes something like this. Investors sell their losing stocks in December to get a tax break. You might have heard of it as tax-less harvesting. And then they buy them all back in January. Plus, you've got people investing their year-end bonuses. All that cash pushes prices up. It sounds pretty plausible, doesn't it? Well, let's look at the data. Back in the 80s, the January effect was a powerhouse. I mean, it delivered really strong average returns. But as we move into the new millennium, you can just see it. That power has faded dramatically. The once reliable pattern has become, well, pretty much non-existent. As the economist Burton Malkiel jokes, the effect became so well-known that traders started trying to get ahead of it, buying stocks in December or even November. And by trying to anticipate it, they essentially erased the January advantage. It seems the market just learned the trick and adapted. But the myth doesn't quite end there. There's another popular theory, a sort of predictive cousin to the January effect, that claims the first 5 trading days of the month can predict the entire year. Now, at first glance, this looks amazing, an 83% success rate for predicting a positive year. But here's the catch. The stock market has gone up in about 73% of all years since 1950 anyway. So the indicator is barely better than just guessing the market will go up. And when it comes to predicting a down year, it's wrong more often than it's right. The bottom line is, it's not the crystal ball it claims to be. So the market myths are fading. But there's a third, far more powerful January reset that most people completely overlook. And it has nothing to do with resolutions or stock picking. It has everything to do with policy. See, on January 1st, it's not just our habits that change. New laws often take effect. For instance, in 2026, a staggering 88 different U.S. cities, counties, and states are all scheduled to raise their minimum wage on the exact same day. And we're not talking small changes here. Nearly all of them, 79 of those jurisdictions, will bring the wage floor to $15 an hour or even higher. This is a direct, legally mandated financial injection for millions and millions of people. Now, this is the real January effect in action today. It's not some strange market anomaly. It's a deliberate policy choice that provides a tangible, financial fresh start with really predictable economic consequences. So where does all this leave us? We've looked at 3 different kinds of January resets, one driven by our personal goals, one by market lore, and one by the law. So what's the big picture here? So let's go right back to our central question now that we have all the pieces. Is the January effect actually a real thing? The answer is yes, absolutely. But it has very little to do with some kind of stock market magic.
The January effect is real because of us, our collective behaviors, our choices, and the systems that we create.
So here's the takeaway. Our personal resolutions create real economic winners and losers. The old Wall Street calendar tricks are fading away as markets get smarter, and the most powerful, predictable reset now comes from policy changes that kick in on January 1st. You also have to remember things like Black Friday are shifting these seasonal patterns too. The whole annual reset isn't about market mystique. It's a story of collective human action.
Which leaves us with a final thought. January acts like a magnifying glass, focusing our collective intentions and revealing these deep truths about how our economy really works. So if this one single month can teach us so much about the power of our shared behavior, it makes you wonder what other massive patterns are shaping our world right under our noses.